Good morning. I think I'm live. We're having some connection issues there to start the show, but good morning, everybody, and welcome back to Beat the Bell, presented by Kane Capital. Hope you guys are all ready to rock. Hope you guys have all had an awesome trading week thus far. Yesterday was an awesome trading day. Lots of range, lots of movement. That's what we love to see. Hopefully, you guys did well. All right, let's bring on the panel, starting with Money Mander. Money Mander, good morning.
Good morning. Happy Friday. Short week's got me all messed up in the head, but NFP just came out. We'll talk about it in a second. Market's liking the data.
The short week has been pretty strange. I'd like to talk about that for a second. Monday, we had the half day. So there was not too much trading to be done then. And then, of course, 4th of July, and it's already Friday. But there have been some pretty good trades, as I mentioned. So it's been important to capitalize on these short weeks. And Noah mentioned on Monday Spaces that, it's not ideal that we have a short week, but we got to appreciate it because I think we're in for a bit of a stretch where we have virtually 0 off days. So it's time to lock back in. Noah, good morning.
Good morning. Yeah, I think the stretch goes to like Labor Day, where I don't believe that we have a market holiday until Labor Day. So no days off here for the next couple of months. But let's get into it. We have some big news that we can talk about for a little bit here.
All right. Let's go into Fed forecast, economic calendar.
Yes, sir. So we just got the NFP print that we'll get to in just a second. But that is the only news for today. So really quick, let's take a look ahead to next week's economic calendar. And so we have a bunch of Fed speakers on Monday with economic optimism on Tuesday. Core CPI number comes in on Wednesday. Those have been getting a bit more muted in terms of like the market reaction to the print over the last several prints, but still something you want to pay attention to. PPI and core PPI on Thursday, as well as those weekly jobless claims. And then on Friday, we've got consumer sentiment. So a decently heavy week as far as high impact news goes next week. But let's go ahead and cover the high impact news from this morning. So like I said, NFP came in this morning at 209,000 jobs added versus 225 consensus. The unemployment rate also dropped from 3.7% to about 3.6%, so down just 1 or 0.01 percentage points right there. The market is basically having a pretty muted reaction here. From the close yesterday, with the ES is only up about 4 points. And it's interesting because yesterday we actually, the market sold off pretty broadly in anticipation of today's print, following strong economic data in both the services activity index, which climbed to 53.9 from 50.3, and private payrolls, which came in at 497,000 jobs added in June, an 86% month-over-month increase, and more than double the expectations of 228,000. The better than anticipated data also sent the indices trading lower. So the Dow dropped by about 1.1% yesterday. The Nasdaq and the S&P both down 0.8%, with all 11 sectors closing in the red. Bonds also sold off on that news, pushing the benchmark 10-year yield past the 4% threshold from 3.9% earlier this week. And again, when we get really good economic data in terms of a bunch of jobs being added and showing a lot of strength in the economy, essentially what people will then extrapolate that out to is that the Fed, expressly, as they said so many times, wants to cool off the economy and thus bring down inflation. And so when you see the economy so strong, it sort of implies that the Fed may have to leave rates higher for longer. This print today is actually the first NFP print that did not come in above expectations in quite a while. And so it'll be interesting to see how the market reacts, once it shakes off these initial jitters. We've actually come back down to essentially flat from yesterday. So really not a ton of movement just yet in the market. We'll have to see if that changes when we open. The last thing that I do want to talk about before passing it to Mander is this global liquidity drop. So all of this economic data that we've gotten over the past couple of days is set on a backdrop of decreasing liquidity, both in the United States and globally at the central bank level. According to GLJ Research, central banks across the globe, including the Fed, the Central Bank of Europe, the Bank of Japan, the Bank of England, and several others, let around 672 billion US dollars, total in value, collectively roll off their balance sheets, right? So this brings the aggregate of all central bank balance sheets to their lowest level since October of 2022. Taking a look at the liquidity index that we've got here, it's got a 98.4% correlation with the S&P 500 dating back to 2009, right? And so, like, the narrative earlier this year was that QT by the Fed, which they said that they would do, letting assets roll off the balance sheet as they attempt to tighten financial conditions. QT by the Fed and other central banks would really be a headwind for risk assets. Think your technology stocks, your cryptos, things like that, right? Essentially, given that narrative at the beginning of the year, we know that obviously risk assets have rallied basically through the entire first half of the year. When you look at the liquidity index, the Fed, while they were engaging in QT, really wasn't, you weren't seeing the sort of liquidity drop come off of the balance sheet. And some people believe that that's because of the situation that we had with the banking turmoil back in March and back in May. You didn't want to see, or at least it was believed that the Fed didn't want to see a situation where liquidity is being drained from the market at a time where there's so much stress being put on these banks. But ultimately, we've this week have seen the largest removal of liquidity from the system in well over several months. And so it's very interesting to see if the market is going to continue the sort of correlation that they've had with the liquidity index basically over the past 10 years. It's been highly correlated, again, 98.4%. It's going to be interesting to see if that continues to diverge here throughout the summer, or if the S&P 500 is going to see some downside and hold true to this correlation that it's seen with the liquidity index so far, as long as central banks, again, continue to drop this liquidity off of their balance sheets. And we'll get probably more information on really how realistic that is and what the path forward there is going to look like at the end of the month in the FOMC meeting. Mander, what do you got?
I think it'll be really interesting because if we go back to March, if you guys remember, call it QE, call it whatever you want, but the Fed basically undid like months and months and months of quantitative tightening when they had to bail out those banks there with, it was a loan and it was at interest rate specific to the 2-year or whatever it was at the time. But at the same time, it still bumped up the Fed's balance sheet, and that brought that global liquidity up. And so I think moving forward, it'll be really interesting to see if this correlation holds true still. What was that look for?
I was looking at a comment, my bad.
Okay. Anyway. I'm curious to see, because as Matt's come on and said, mechanically and structurally, we are set up for the squeeze into the end of the year. But then as we have this global liquidity starting to pull down, I'm curious to see which one holds true, because like you said, a 98% correlation in something in this market is definitely worth noting. So we'll see how that pans out moving forward. The one thing I wanted to touch on is the bond market repricing after the minutes release and the jobs data that just came out. So going back to the minutes release that just came out on Wednesday, the worthy notes here were all participants expected more rate hikes in 23. The staff still sees a mild recession later this year, followed by a moderately paced recovery. They said the probability of avoiding a downturn is just about as likely right now as a recession baseline. And core inflation had not shown sustained easing since the beginning of the year. So as you mentioned, with bond yields ripping, the 2-year and 10-year are both back up over 5% and 4% respectively, almost back to a triple-digit inversion as well, and at decade highs here, really back that we hadn't seen since March, before the financial downturn of the banks that really, had everyone thinking the Fed was going to pivot early, had yields come down, and everyone kind of bought up the high they thought of in the bond yields. Obviously, the Fed has come out and said that's not the case. Financial section is resilient, and they're still looking for another 50 basis points into the end of the year at that median terminal rate projection. So I think, everyone in the bond market's looking at this uncertainty as, we got to the original 5.1 between 5 and 5.25 terminal rate. And now you're coming out at this meeting saying we're going to pause and not quite get there yet, but then another 50 basis point projection to the end. So then what's to say when we get there, they're still not going to revise higher and higher. So right now the bond markets are pricing in a 92.4% likelihood of a hike at the next meeting. And now only a 5.8% chance that we get a single rate cut into the end of the year. When, if you remember, a month ago, we were looking at like a 10% chance we got down to 4.5 to 4.75. Now there's only a 5.8% what I say, 5.8% chance we get below 5.25. So big repricing there as these yields are squeezing on this higher for longer narrative. And I think as we're kind of getting to this really overbought section of the market, this could really be that catalyst, along with the global liquidity that you said, for a meaningful pullback. You had mentioned we hadn't had a pullback of over 3% in the past 3 months in the S&P 500. It's really been unprecedented gains. The NASDAQ has seen one of the highest first half of the year we've seen in 30 years. So I think this could be one of those catalysts as yields begin to reprice, especially with those higher risk, high betas on the end of the risk curve there. As the 2-year gets above 5%, we have on the yield curve, I think the 6-month is back to like 5.5%. Those are going to be the ones, as we saw yesterday, the IWM was down at 2.5%. I think those are going to be the ones that really start to see profit taking moving forward here.
Yeah, no, look, and there's so many different anecdotes that you could pick up and say, well, the market's going to sell off because of this. Look at the global liquidity. The market is not going to sell off because of this. When is the market ever sold off in the month of July? Ever? Literally, I don't think ever. So you have so many little data points that you could try and point to and say, look, historically, this is what happened here and this is what happened here. I think really the people who are going to win are the people who are just following the price action and sticking true to their systems. I mean, when we bring you guys these things, when we bring you guys the central bank liquidity, when we bring you guys, yields rising and looking forward, these are just things to have on your radar. They're not necessarily mean that, we're going to wake up tomorrow and we're going to be at 3,500 SPX. So just keep that in mind, play the price action, and we will pass it back to Alejandro.
All right. Awesome stuff. Definitely agree with that. Let's do some system, taking a look at the S&P here. Quickly going to share my screen. So we got the sell signal on the 6th. As you guys can see there, we got the cross of the 10 SMA below the 50 SMA on the 30-minute SPX chart. And we've been trading down since then. So we've been chopping around below this 50 SMA, but late day yesterday, we did recover the 50 SMA on the 1-hour chart. And that 50 SMA on the 1-hour chart is still in a strong and steep uptrend. So as long as that holds, and things are pretty flat here to start the morning in the S&P futures, as long as that holds, I would like to believe that the uptrend will resume or the uptrend will remain intact. And yesterday's low is a very, very important level. If taking a look at the S&P futures, that's that 4420, which was low of day. That level marked the breakout of the giant bull flag that we broke out of last Thursday and Friday. So that giant rally, all we did was we sold off, we back tested, and so far we held. So bulls want to continue to hold that level. Keep it in mind, 4420 ES. That's the S&P futures. Now, if we can reclaim the 50 SMA on the 30-minute chart, that is ultimately going to put bulls back in full control, and we'll be looking for that for opportunities to get long. All right, so that's going to do it for the system. Going to pass it over to Snipes now, and we're going to do Bet the Bell.
Good morning. Let's do Bet the Bell.
Can't see the stats, unfortunately.
Technical
What are we looking at
for us?
That sucks. I think you guys caught up.
I took green with you. I think Noah might have got one back.
When?
Yeah, no,
Wednesday?
Yeah.
It was Wednesday was red?
Yeah, it was.
Nice.
There,
yeah. If I remember correctly, that was massive for me. I think that tightens the race. Honda probably has to go one game.
Gap filled and closed like a 10% down.
All right. Let's do it.
All right, let's kick it off. So I'm going to have to start with the first and always first question that I got for everybody. Green or red today? Diamond, what do you got?
I will go red. I don't appreciate always having to go first, to be honest, because I feel like they like game theory off of my answer. But I'm gonna go red. Yeah, you do. I'm gonna go red.
I'm going green.
Hondo, you got green?
Yeah.
It's official?
All right. Blind Squirrel finds a nut here. I got to stick with green. I would take that anyway, even if I was right on Wednesday, but I'm thinking green here off the NFP numbers.
I'm going to have to take red, but let's dive in right into the next question. That's going to be pretty similar. NVIDIA, over or under $420 today at close? What do you guys got? Diamond.
423 in pre-market. I'm gonna go over. I mean, that seems like a no-brainer, unless they have a bearish engulfing to the downside, which is possible, but unlikely. Green.
It is possible though. I mean, we have been under 420 in the pre-market as well. Just so
Yeah, I'm gonna hedge my bet. I'm gonna hedge my red bet on the first question.
Okay, Hondo, what do you got? Over or under 420?
I'm going over.
Over.
Strong name.
So what do you got?
I'm going to buy some value off the Vegas line here. I'm going to take over 425 for some better odds.
Over
I
425.
think we see a green day, and that'd be 0.5% up from where it's at in pre-market here. I think we see over 425.
This is a very bold call here.
Taking it, hammering it.
Okay. I'm going to go ahead and get into my next question. Not sure if we're able to pull up the tweet, but Uber, DoorDash, and Grubhub joined forces in suing New York City to block a new rule of minimum wage for app-based food delivery workers. My question for you guys is that a city-related problem or is that a national-related problem? And do you think that they're worried about this kind of expanding outside of New York City and taking over the entire country? What do you guys think? I'm going to have to start with Mander.
Yeah, I'll start here. I think for New York in specific, I mean, if you guys have seen the rent inflation in New York, it's out of control. So I think maybe in New York City, it makes sense. But across the country, usually how it works is if you're a tip-based employee, you don't have to get paid minimum wage as long as you're clearing that with your tips included. So if you work at a restaurant, that's why waiters don't get paid on an hourly basis. They clear more than that when you compensate it back with the tips they make. So maybe in New York specifically, but I don't think this makes it across the country. I think that would be pretty ridiculous.
I agree with that. Diamond, what do you got?
I mean, I'm kind of in the same boat. I mean, didn't California try and do something similar where it was like they wanted to essentially have to pay these people minimum wage, which, like, on one hand, I do understand, like Mander said, if you live in a place with a really high cost of living, it is probably tough to clear that, right, through just tips alone, especially, I don't know. I mean, I have like a soft spot for these people. I used to do Grubhub like really early in my college days, and I loved it. So I don't know. It is tough. I always like made like well over minimum wage too, which is like weird. I guess like in a city, it's probably like a lot more congested, but I would also imagine that you get like a lot more business, like a lot more orders. So I don't know. It's very strange, but I do kind of lean towards Mander's sentiment that like it might make sense in a big city like New York or maybe like Cali, like Los Angeles, but otherwise I don't think it's really feasible unless you want to pay like, double 2.5x the price for your order. Because that cost is going to get passed on to the consumer. Like the company's not going to eat that.
They're losing my business at that price.
Yeah, like you think Grubhub's just going to eat that loss? Like they're going to pass it on to you. So
yeah, so we got the first New York resident that is pro. Hondo, I'm gonna have to ask you, and this is the
well. Listen, so just so I'm understanding the argument here, basically they're trying to pass a law for minimum wage, and they're trying to block that, correct? Okay, so I mean these guys are very hardworking individuals. I also think that the Grubhub delivery service, like the bike delivery service, is super competitive in the city of New York. It's not like just delivering in any given suburb. This is really how these people make a living, and they work extremely, extremely long hours. And now I feel as though, just from what I see, the market is definitely becoming a bit saturated with the amount of guys that are delivering. And I wouldn't be surprised if some of these guys are pulling in less than minimum wage. Not every day. I think maybe by the end of the week, depending on how many hours they're working and how much money they're able to pull in on tips, that they do pretty well. But that being said, I could definitely see them having some pretty bad days, and I would definitely be in support of this whole minimum wage thing. Again, just because. Go ahead, Noah.
I think that's almost a good thing though, right? Like I think if the market is too saturated, like go do something else. Like That's how economics works. Is like if too many people are doing one thing and the cost that you get paid for doing that thing has now gone down because there's too many people trying to do it, that means that you should probably go do something else. I know obviously for a lot of people
Yeah.
it's not just that
I
easy
mean,
to
like,
pick
it's
up and
not
move.
as easy.
I understand. I got you. But I'm just saying, like, that's how it's supposed to work, is it not? Like, for everybody who every time that somebody wants to have a job that is
No,
convenient,
I
it
understand
is
that. I
convenient.
understand
Like,
that.
especially for
But
me, like
when
that's why I did it, is because it was convenient, right? Like, you could pick your own hours. Like I told you, I really loved it. Like, pick your own hours. I got paid
yeah, all right.
pretty
You
well.
were also You were also a college kid who,
I didn't have a
like, you
family.
didn't need
Yeah.
the money.
Right.
Like, your money was to go out and drink. It's different when
Relax.
you're a 30-year-old guy who moved from Ryan's putting us in the arena here. It's different when, let's say, you're 30 years old, you're coming over from a different country, you don't speak a lick of English, you have a family to support, and you see this as the only way you can make money at this time. It's a very different situation than just go, do something else. Like, I mean, a lot of these people would like to do something else, I would like to think, right? But given their situation, they can't, or at least for the time being. I mean, you're definitely underestimating the fact that a lot of these people don't even speak the language. And I'm just telling you based off of what I see. Like, I see outside of my door, or anytime I get a delivery, like, I'm just seeing the type of people that are delivering. Yeah, and for that reason, I think, yes, the market is oversaturated. Yes, I'm sure that these people would not want to be on bikes, especially during the winter. I mean, Jesus Christ.
Yeah, I mean, look, what's going to happen is if this law gets passed, the price of everything obviously will go up in terms of whenever you order from wherever you order, right? Eventually, people in theory would order less if the price of the same thing is going to go up, right? For the same good, you would order less of that good, right? They're going to get less business and they're going to be able to hire less people. And so those people are not going to have jobs anyways. So that's how I look at it.
Yeah, I mean, I think that Grubhub is going to have to wear a lot of the cost. I don't see, or the delivery service itself, whichever one it is, Uber Eats, same thing, because, I mean, it's already outrageously expensive to order Uber Eats, right? So I would imagine that they have to figure something out on their end. But
take Noah. I see this bad for the stock if this law gets passed.
Wow. Very interesting debate right there between the two New York people.
I don't live in New York.
Whatever. You classify as a New York person. Funny story. I was actually with Hondo like a month ago or so, and we were at like some juice place, and like I was looking outside at a bike, and I never seen anything like it, like with the little hands, on the bike.
What?
Yeah, just first time I ever saw that, and saw that like about a week ago. But
Wait, a bike?
Yeah, like on like a bike, like the hand things.
What's he talking about?
what is he saying?
What?
I zoned out.
The handlebars.
The handlebars?
Like, yeah, but like the things you put them in. I don't know what they're called.
Oh, the mittens?
Yes.
That you put, yeah. You know how they put mittens on their bikes?
Yeah, I've seen that.
For when it's cold?
Oh, yeah.
Yeah, on the...
I thought he said it was the first time he saw a bike. My bad.
Obviously not.
Like,
Well, he
what?
was definitely acting like it.
Dude, I could just never seen that before. Whatever. Not a big deal. That'll wrap it up for Beat the Bell today, guys. I'm going to pass it back to Hondo here.
All right. That's going to do it for this morning show. That's going to do it for this week. Hopefully you guys have all been trading well. It was a short week, as we mentioned earlier in the show, but next week will be full throttle, and we will see you guys back here on Monday morning, 8:30 a.m. Eastern time. We'll be trading live all day in the Kane Capital Discord. Per usual, you can go to kane-capital.com. You can go to the Kane Cap Twitter, hit the link in the bio, hit the link in any of our bios. We've got a 7-day free trial going right now. You can scan the QR on the screen. Other than that, that's going to do it. And we'll see you guys back here Monday morning, 8:30. Have a great weekend, everybody.